Order filled.
That is going to do it for Market Makers today. Thanks for watching, everybody. Tomorrow, we'll introduce you to the Charity Angels. They are models charities hire to use their persuasive powers to get prospective donors to write checks. We'll be talking with the founder, but right now it's time for Lunch Money with Adam Johnson and Alex Steele. Adam, Alex?
Those models very persuasive indeed. Thanks, Eric. All right, this is Lunch Money on Bloomberg Television, and we are streaming live on your tablet, your phone, and Bloomberg.com. We're everywhere you are.
Order filled.
I'm Alex Steele. We're going to give you a tour of every asset class and every market around the world. Adam, we're picking up a little bit of steam to the downside here. We've had a triple-digit range in the Dow for 7 out of the past 11 trading days. We looked like we were taking a pause today,
Yes.
but now picking up some steam here.
Yeah, we opened higher and really having trouble here at midday. Here's what's so curious about the action day. We had better U.S. mortgage applications, we had better European manufacturing, and yet we just can't seem to hold those gains. Concern around the world about whether central banks are really committed. That's one of the issues. We're going to try to get to the bottom of this. That's one of our tasks today. Figure out what exactly is driving this market.
And can bond yields and stocks rise together, or do they have to diverge? That's a question, too. All right, let's go around the world for a look at what's ahead on the show.
And let's start with currencies here. Traders at some of the world's biggest banks have allegedly manipulated benchmark currency rates used to set the value of trillions of dollars in investments. Coming up, we'll talk to one of the Bloomberg News reporters who broke this story.
And in fixed income, the bond king reshuffles his portfolio. PIMCO's Bill Gross cuts his treasury and muni positions in the flagship fund. But is it a bet on Fed tapering? Gross says not so fast.
In commodities, it's the crop drop. Corn and wheat getting hammered after the latest government report on inventories and stockpiles. We're going to break it down and what it says about the health of the crops going forward.
All right, so stocks opened strong. In fact, futures were up all night. We had some better data, and then all of a sudden, things kind of fell apart. And it all happened within the past 30 minutes. All right, time for your sector report. Let's check the markets right now. And you can see the Dow Industrial Average down
Order
58
filled.
points. The S&P is down about 0.4. The Nasdaq is down, call it 0.6. Just so we're all on the same page here. Look at that action here. We opened higher, and you can see very clearly what happened over the course of really the whole morning session. Let me show you some of the standout groups. Telecom had been the best performing, as a matter of fact, for the third day in a row. Obviously, you know why you go to telecom. We talk about it every day. 4.4% dividend yield. That's why you go to telecom. Had been doing pretty well up until about 20 minutes ago. Now you can see we're down 0.25%. So even the defensive sectors are struggling. I wanted to point out technology down, call it about 0.33%. It had been hanging around the flat line. Technology accounts for 19% of the S&P 500. It's the largest group within the S&P. And it was holding steady, which was indicative of just kind of a quiet market, not so sure where to go, and now down 0.33%. And finally, financials, which account for 17.5%. They're the second largest group. You can see where they are down about 44 basis points right now. And we just
Order filled.
about what's happening with financials and the possibility that foreign exchange traders were manipulating markets. You know, it seems, Alex, like every 5-6 weeks there's some other negative headline that just undermines the credibility of the banks. And when the second largest group in the S&P can't seem to get its act together, that's a real problem.
It is, and we've heard it also in the commodity sector as well. So to your point, sector by sector, we seem to hear those issues. All right, well, for more on the market action today, we're joined with Martin Sass, the chairman and CEO and founder of MD Sass Associates. Over 40 years running his own asset management firm. Martin, it's so great to have you here. And you started this year off bullish, right? You're 1580, saw stocks as undervalued. What do you see now?
Right. Well, as you pointed out, I expected 1580. We hit it. I think we're at fair value, slightly above fair value, actually, in the market. Things have gotten choppier since May, when interest rates started picking up and tapering discussions increased from the Fed. So we've had more volatility in the market. I think the surprise is going to be a couple of surprises. One is I think we're going to have a longer lasting economic expansion and bull market than most expect. So even though the bulk of the overall market gains have been realized already this year, in my opinion, we have a lot of legs to this bull market, probably another 3 years to both the market and the economic expansion.
Okay, $1 million question. Why?
Several reasons. So one, we have this ZIRP policy,
Right.
zero interest rate policy, negative real interest rates.
But they're turning positive now as the yields rise, however.
Well, interest rates are rising, as you point out, but they're still negative in real terms.
Even factoring in low inflation?
Yes. Well, if you assume inflation is running at 1.5%, 2%, so unless you go out past 10 years, you're not getting any real return on treasuries, as an example. Typically, treasury bonds, we can talk about this later in the bond segment if you like, but typically treasury bonds will trade at nominal GDP growth, so that would be 4.5%. We're at 2.2 yesterday. Even though that's up a lot, it's still well below where it should be.
Order filled.
Sustained economic expansion. So why is sustained expansion? Typically, post-war expansions last about 5 years, which would suggest this expansion would end in mid-2014. But we've had subpar growth. We've had 4 years of 2% average GDP growth, which has left a big output gap between actual output and potential output in the economy, and also a big employment gap with high unemployment prevailing. So that gives a long runway for the economy to expand without big increases in inflation, which that overheating is what typically
and presumably put to work that cheap money brought to us by low rates.
Exactly.
But the problem, of course, is where do you find the value when you have seen a run-up in stocks already? At some point, the S&P hit a record.
Right. So the overall market is fair value for the first time on our valuation model since '99. It's been significantly undervalued for the last 4 years. Now we've gotten to fair value, which is really where it should trade. But some stocks are underpriced, some are overpriced. So, for instance, the defensive stocks, which have been the so-called safe havens, are generally overpriced, in my view, higher multiples than they should be. They have high dividend payout ratios and very little room to expand them. On the other hand, you have a bunch of stocks in a number of different areas that, including one which is considered defensive, that is healthcare, where there are tremendous opportunities. They are underpriced. They have double-digit earnings growth, and the stocks aren't showing, reflecting that in their valuations.
So there's a value play. You also sound like a dividend guy to a certain extent, but what's curious to me also is you like writing calls against your long positions, getting paid to wait, in effect. Is that right?
Yes. Well, we have two different strategies. One is a long-only equity strategy. Another is a hedge strategy. One of those hedge strategies involves writing covered call options against high dividend-paying stocks to provide significant cash flow. We call it equity income plus. That strategy generates roughly 8.5% standstill returns. So if the stocks do nothing, you make 8.5%, 3% roughly from dividends, 5.5% from writing out-of-the-money call options. And so you get 8.5% standstill return. The trade-off is you don't get as much upside in the stocks because they can get called.
So if healthcare is one group where you'd employ that strategy, what would be a couple other sectors?
It's really across the board. So we have 40 stocks in the portfolio in virtually every industry. We have
Order filled.
Healthcare, by the way, has some stocks that don't even pay dividends that are not in that strategy that are very exciting. So, for instance, the generic drug companies are a solution to the healthcare cost containment problem around the world.
Which ones in particular you think have the value?
Two of them I'll give you. One is Actavis, which is the former Watson Pharmaceutical, symbol ACT. This company will show, we think, a 52% gain in earnings this year, a 57% gain next year.
Wow. That's real money.
Double-digit gains after that.
And not just from buybacks or anything like that?
No, this is real earnings. Organic growth plus accretive acquisitions they've made that will result in earnings much higher than Wall Street expectations. Guess where the multiple is on this double-digit growth?
I hate to think if they've been making acquisitions. Where is it?
8.8 times 2014 estimated.
Cheap.
Wow.
Really cheap. Another one that is also undervalued in our view is Mylan. So this is the number 2 and 3 generic drug manufacturers globally.
Right.
Actavis and Mylan. Mylan is a very widely diversified drug company. They just acquired a company called the Gila, which makes generic injectable drugs. High profit margin, high growth. It'll be accretive. The stock trades at 10 times this year's earnings, 8 times next year's earnings.
So finding growth in safety at the same time.
Exactly.
Helping with options. Interesting. Great strategy. Good to have you.
I love having a stock picker on the show.
Don't you? Yeah.
You know, it's fun. We
Look at
actually
you,
get ideas.
nitty-gritty.
We're going to share plenty of those with you. All right, so here's what you need to know up to this point. This bull run will last longer than most, but the growth may be a little bit slower. Marty Sass likes healthcare. You just heard him make a case for Actavis as well as a Mylan. We're going to get more picks from Marty. We've got a lot coming up ahead. We'll also get into that dividend and options trade.
Lots going on. Lunch Money is just getting started. Here's a look at what's still ahead.
Currency controversy. How traders at some of the world's biggest banks are manipulating rates. A Bloomberg exclusive. Crop drop. How the latest government report is affecting grain volatility. And know your options. A trade that could double your income in a world of low yield. First, Bloomberg.
This is Lunch Money on Bloomberg Television, streaming on your tablet, your phone, and on Bloomberg.com. I'm Julie Hyman. Tracking news and currencies this hour. The Australian dollar rebounding from the lowest level in almost 3 years after tumbling 9.2% since the end of March. A technical indicator signaled that the recent selling was perhaps overdone. And the pound is rising today to a 3-week high against the euro after a government report showed UK jobless claims fell more than forecast last month by economists. Sterling has gained almost 6% 6% now in the past 3 months, making it the best performer among 10 developed market currencies. And for today's cover story, exclusive reporting by Bloomberg shows traders at some of the world's biggest banks have been rigging a key part of the foreign exchange market. The allegations coming from 5 dealers with knowledge of the practice, and this involves the manipulation of market benchmarks used for trillions of dollars of financial instruments targeting currency spot rates. Here to help break this down is Bloomberg reporter Liam Vaughn, who co-authored the story. Liam, welcome to Lunch Money. Thanks so much. Interesting story here. So talk to us about these FX benchmarks and how exactly this rigging happened, according to the folks you talked to.
Sure. So these are called WM Reuters benchmark rates. They're published for about 160 currencies every hour, and some of them are published every half an hour. And they're used wherever you require a kind of standardized exchange rate. So, for example, FTSE use them to compile their indexes. Pension funds use them to value their assets on a daily basis. So they're, used throughout the financial system. Unlike LIBOR and other benchmarks that we've seen, these are rates that are set based on actual trades. So every hour for a 60-second window, all trades are monitored and a median is taken, and that becomes the published rate for for that specific currency. Our reporting suggests that actually what banks are doing is they're using their full knowledge of clients' orders to position themselves ahead of clients, front running, and also to try and manipulate and move where that benchmark is published. I mean, it's a fairly complex process, but it's a
filled.
easy concept to understand because we've seen it with so many other markets now.
And it also seems like it's fairly widespread, as your story seems to indicate. But what are the consequences of this? I mean, besides these banks putting more money in their pockets, so to speak, what does this mean for their clients? What does it mean for the broader markets?
I mean, one of the reasons we started this investigation is because we spoke to, senior investors, big institutional investors, and they came to us and were aware of our reporting on LIBOR and were frankly very frustrated at this kind of process and felt like they were being ripped off. I mean, the way it works is that institutional investors or companies will typically get in touch with their bank ahead of these fixes and say, hi, I want to do a trade at, say, for example, the 4 p.m. fix in London. There's a 45-minute window there in which the bank can trade against their client, and what it means for the client, and therefore indirectly what it means for you or I or anyone that's got a pension, is that they're getting a bad deal on their foreign exchange, and therefore returns on pension funds are impacted negatively, and who's benefiting from that? It's the trader.
Well, we know that regulators have been investigating the LIBOR scandal that you referred to. But what can they do about this? I mean, we're talking about essentially front-running the clients, but it doesn't seem as though this is out and out illegal, right?
I mean, we're talking about a kind of range of behaviours. So there is a kind of sense that front-running, to some extent in the FX market, which is not particularly highly regulated, is accepted practice, albeit undesirable. But what we're talking about is actually traders, via instant message, phoning each other and saying, look, I've got a big position coming through at this close. How are you fixed? Are you positioned the same way?
So
and suddenly, if there's 5 of you that are all positioned the same way, absolutely. We're talking about kind of collusion on a regular basis, and also you need to consider the FX market is very concentrated. Even though it's something like 4.7 trillion a day is traded in FX. I think it's something like 4 banks control more than 50% of the market, 10 banks control 80% of the market. So yeah, it's a big market. It's tough to move these rates, but these guys have got the wherewithal and the ammunition and the kind of trading volumes to be able to do it.
So Liam, just quickly here, give us some perspective on this compared to the LIBOR investigation. How big is it? How severe is it?
I mean, it's very early stages. Already we've learned that the UK regulator, which only came into force in April, is interviewing relevant parties, is aware of it, and is now under increasing pressure to launch an investigation. So, for example, our understanding is that various politicians at a kind of European level are leaning on the UK regulator, saying this is serious, you need to have a look at it. How far it will go, your guess is as good as mine, but certainly in terms of the impact, the financial impact, it could be every bit as big as LIBOR.
All right, Liam, thank you very much for joining us to help explain this a little bit more. Liam Vaughn, reporter with Bloomberg News, bringing us this exclusive story on currency traders allegedly manipulating FX benchmarks. Alex?
We have some breaking news that we want to update you on. Stephen Hester will be stepping down as CEO of RBS later this year. RBS saying it is considering both internal and external candidates. Again, Stephen Hester will be stepping down as CEO of RBS later this year. The search for the successor begins. All right, well, turning to commodities, it's the crop drop. Corn and wheat getting particularly hammered at after the latest USDA crop report. We're going to break it down. That's coming up next.
Target filled.
Welcome back to Lunch Money. We have some breaking news. You're seeing live pictures from Taksim Square in Istanbul, where people are moving back into the square. Recall last night those protests turned very violent. We saw lots of flames. We saw the police firing tear gas as well as water cannons into the crowd. The crowd left, and again, you see now, roughly 12 hours later, people moving back into that square. We'll certainly keep you apprised of any developments. Istanbul's Taksim Square.
All right, we'll be keeping an eye on that, Adam. Thank you. Well, you are watching Lunch Money on Bloomberg Television. I'm checking your headlines in commodities. Uranium could actually rebound from its worst slump in 7 years as Japan starts nuclear reactors after safety requirements are put into effect next month. And the U.S., well, is overflowing in oil. Production grew at the fastest pace since 1965, and that's according to BP statistics, and that's all from unconventional sources like shale and tight oil. Our cover story for today, though, is the crop drop. We have some drastic price movements happening right now. Corn is down over 2.5%. Wheat is off over 1.5%. And soybeans also down over 1%. How? What did the U.S. government say that made traders get so bearish on these crops? Well, joining me now from Atlanta, Ashmead Pringle, founder and chairman of Greenhaven, and manages $523 million firm-wide. Ashmead, it's interesting because when I look at the actual headlines, they sound actually a little bit bullish. You have corn inventories are smaller than what the government forecasted last month. Wheat also smaller forecasted on the recent drought, and soybean inventories may actually more than double. So maybe soybeans were a little bit bearish, but in terms of wheat and corn, that sounds bullish to me. Explain why prices are down.
Well, Alex, they were trading down really before the report, and I think this report didn't tell us a whole lot that's new, and the June report usually doesn't. While the corn stocks were cut slightly, we really expected that they would fall a bit more, perhaps by 200 or 300 million bushels, because we think that planted acres are probably 2 or 3 million acres less than what was used in the May report. So I actually think that USDA is kind of conservative here, and we would not look for a 14 million or billion bushel crop ourselves this year.
Are you looking for more than, Ashmead, if you're looking at corn?
Oh, no, we'd be looking for less. We think there was an acreage cut, and we think, you know, yields may not be above the 155. It's going to depend, but acreage definitely down. A late crop could be more vulnerable to a frost. But the picture that was painted earlier is really of rebuilding stocks globally in corn, wheat, and soybeans, and that really hasn't changed. So even
is it possible then here in the U.S. we have maybe a perhaps more bullish outlook for corn, like you said, that yields won't really match up, but worldwide we're seeing an inventory build?
Well, it's a slight change, I think. Instead of 1950, we'd say maybe it will be 1750, but that's still a great increase over last year's 800 million bushels or so. And you got to remember, half of, well, until recently, we've exported almost half of our crop. Now, with the drought last year and high prices, our share of the export market has shrunk pretty drastically. So we'll have to compete to get that share back. So
good point.
It's not particularly bullish for us.
So going forward, are you relatively neutral on prices, and where's the risk here, upside or downside?
Well, we are relatively neutral on prices in the long term. You know, if you look at prices over the forward curve, and we tend to look at the price of all three combined, one soybean, one wheat, one corn, and we think we're in around a $25 average zone, to a little above that. So we think prices are pretty fair going forward. The risk is to the upside if we have supply problems, particularly in soybeans.
Ashmead, great. Thank you. Really appreciate it. We have to leave it there. Here's what you need to know. Ashmead Pringle of Greenhaven says the USDA crop report, you got to take it with a grain of salt. He's pretty neutral on prices, but warns there could be upside risk based on weather issues. And coming up, there is much more on Lunch Money. We'll be back in 2 minutes. Stay with us.